All right, guys, welcome to the webinar. We're going to be talking about the market profile and auction market theory. I think even if you don't trade futures, the auction market theory is a very important principle to understand how it's basically an explanation on how every type of market works, not just futures, it could be stocks, real estate. This principle applies to every single market. But yeah, before we start, just a disclaimer. We are not registered as securities broker dealers or investment advisors, either with the SEC or any state regulatory authority. We are neither licensed nor qualified to provide investment advice. All trades posted in this room are for entertainment purposes only. We are not liable for any potential losses. That being said, let's start. So, auction market theory. It is a very important fundamental concept to understand the market profile. The best explanation, the most simplest way to explain it is you can see the market as a two-way auction process. So it's like something like eBay, for example. A seller will offer an item at a certain price, and the buyers will bid it up higher and higher until there's no more buyers. And the majority of the buyers are willing to purchase the item at a fair price, which is essentially the price that most are willing to pay. So that'll be represented by the point of control on the market profile, which we will go into. What is that beeping sound? Heck. Yeah. So, for example, a seller could have a price set at $100. But if no one wants to buy it, the seller would have to lower the price until it reaches a price that buyers find it fair to start bidding. So he could lower the price to 99, no bids. Okay, 98, no bids. 97, 96. So let's just say this price that we finally find buyers is $95. So when it hits the price of 95, it acts as an advertising mechanism for the buyers, because like when it's like $100, nobody's interested. When it's 99, no one's interested. 97, no, okay. 95, okay, then yeah, that's fair. So you'll see some buyers step in. It's the same principle this principle works in the market as well, because the reason why price goes down in a stock market or futures or options is because nobody wants to buy it. So going back to the example, when it reaches $95, you'll start seeing the buyers offering up some bids until the buyers get exhausted and have no interest in purchasing higher. So what will happen is that when it hits 95, it'll act as a little advertised mechanism, and the people will be very interested in buying 95, and then you'll start seeing some momentum pick up, perhaps some reversal, and it'll keep bidding until there's no more buyers again, because the price is deemed too expensive at the current time. Now this could change, but we'll go into that later. The price might rise even way above 100 when previously no one wanted to bid at 100. But the fact that price is moving up can act as an advertised mechanism, and it creates this excitement, and it gives buyers more initiative to start showing interest. So when we reach higher prices after the bids start coming in, the auction will start slowing down, and it will get temporarily exhausted because price can never. Sorry, is this a little beeping sound in the back? Oh, never mind. So like I was saying, price does not always go up. We usually cycle between a buyer's and seller's market. So you'll see, the buyers push up the price and then the sellers push it back down. So yeah, when the auction slows down and the buying gets temporarily exhausted, it could do two things. One example is that it could slow down and stall and begin falling back to whatever is deemed as fair value at the time. If the buyers deem the current price as overpriced, or it can consolidate, build some momentum up. Build up some steam, some energy for the next move, because once this consolidation period is over, you'll have another breakout, and that's when the momentum starts coming back in. So once it's finishes consolidating, it will move higher due to emotional response or motivation that gives the perception that price is perhaps still a good deal. So the second key point is you could think of the market as a two-way auction process. So this is an important rule because you should never assume that price is too high or too low. Oh, sorry, this is a different. I think I already. Sorry. I messed up on the key points, but sorry. We're going to skip to this one because I already talked about this one. Never assume that price is too high or too low. So an important rule is that you should never assume price is too high or too low, as a fair price can move up and down depending on the perceived market value. So for example, you may not be willing to pay $100 for a stock, but some people might consider it a good deal and bid it up. So there are some factors in the market which people will buy at fair value or sell below fair value. The reason for selling below fair value is because people are being emotional. They're not being rational at this point. Because if, let's just say, the mean or the point of control is 100 and people are buying at 100 or they're selling below 100, they're not being rational. Rather, something has happened that caused them to panic and run out the door. And you could think it's like a movie theater, right? It's a little dark example, but it's like a movie theater. You get people in a movie theater, and if it's on fire, the exit remains the same, and everyone's gonna run for the exit. A little dark. Sorry. So the next key point is, in the market, higher prices will always bring new activity. So when you have price move up, it like we said before, it acts as an advertising mechanism. The movement of price would always attract potential buyers or even sellers. So you could say that. So to put a good example, that higher prices bring new activity. Like, let's just say Apple stock, for example, is at $140, right? And it's consolidating. Nothing's really changed about the stock. There's no change in fundamentals, nothing. But let's just say in the short term, it breaks above 140. It breaks out of this consolidation area. You see it start getting some momentum because let's just say it's making new 72-week highs. That acts as an advertising mechanism because you get people who get greedy, who FOMO in. It's all emotional buying at this point, and it's That's just one example of why. It was just one example of how these higher prices could bring new activity. Um, Also, another way higher prices could bring new activity is if it moves up very quickly to like 150, and then you have a lot of guys who were patient before it, who bought in lower at like 100, 140, whatever, and they see 150 and they start thinking, okay, maybe this is too high. The buyers are not stepping in because nobody thinks this is fair price, and you get some sellers coming in, but there's nobody for the sellers to sell to. So then this is when you have a pullback because there's not enough buyers to meet there's not enough demand to meet the amount of supply being um, sold at the time. So yeah, the same concept could be seen in market profile, where we see the price hovering around the point of control, which is, like I said, a fair value. And whenever it deviates, we take it back to the fair price, unless we have a trend update, and you got to be careful. But like I said, I'll get into that a little bit later. The next point is that you always want to remember that price is nothing more than an advertising mechanism for the market. I emphasized this previously, but I need to stress the importance of this principle, because I've heard a lot of things, like people saying, "Oh, this stock is too expensive. It's $100. I want to buy a cheaper stock." But what makes okay, a stock that is $100 or $50? It doesn't matter. I mean, if it's undervalued, it's undervalued, right? You don't want to look at the dollar value and think just off the dollar value it's too expensive or whatever, too cheap. Yeah, I'm going to yeah, I just sorry about that. If you're No, sorry. I'm still in the beginning stages of I still have, like, a lot of slides to go over, so, um, what was I saying? Yeah, so, yeah, you can't assume price is too expensive, 'cause what if, like, relative to the market cap, it's, like, well, relative to okay, if you have a company in a sector and comparing it to different, competitors, and their market cap is much, much higher, but let's just say fundamentally they're not as strong as this company, you could say it's cheap, it's undervalued. But yeah, that's just one example, I would say. You basically want to be a machine that you trade off of. You trade solely off of real time data, and I wouldn't say ignore the news, but you sort of disregard the news unless it's something like very, very important, then like something financial related. But generally, like these PR stunts, you want to ignore. Okay, so next slide. The next point is the motives and incentives that drive the buyers and sellers are virtually infinite. So what this means is y- y- what this means is you're going to end up driving yourself crazy if you try to find like the, every single reason why price is moving up and down. But like, okay, like you why is this stock tanking so much? Like, is there news? And if let's just say there is no news, and you're just driving yourself crazy trying to figure it out. Why you're concentrating on the wrong thing. What's important is you should focus rather on the market data, what it's telling us through price, time, volume, where it's at relative to its this is on the daily chart where it's at relative to its range. I think those are the more important aspects of the market. So yeah, the auction market theory is basically the theory that ties this all together and explains the inner workings of the market. Next point. So now we're going to go into the market profile. So yeah, before I was explaining the auction market theory. Now this is going to apply this theory into this into this charting system. So yeah, if you're looking at the market profile, you can see that we have a bunch of letter sequences. So A, B, C, D, E, F, G, so on and so on, right? Each letter sequence represents 30 minutes of price action. So you could consider each column of letters like a candlestick, right? It's just a candlestick chart. It may look a little confusing at first, but this is the first A is the first 30 minutes, so it's like a 30-minute candle. B is the next 30-minute candle that's printed. C, D, etc., etc. Basically the alphabetical order just organizes the order of which the price action moves during the session, whether it's the New York session or the Globex session. So yeah, next slide. So the TPO breaks down and it defines the market's value with variables like price and time. This is the S&P 500 futures represented on this market profile chart. It's essentially there cannot be value without time spent at a certain price. So that being said, like we said before, price is an advertising mechanism. Price simply explores where people want to buy and sell. But value is really developed by time spent at that price and another variable, which is volume. So if you look at this market profile chart, the widest part of the chart would be considered a time point of control. Obviously, we don't have an area where it's the most widest at this point. You got pretty even distribution right here, but let's just say you had a little bit more distribution at this one area, for example. That would be the time point of control. And you could say that the time point of control is fair value at the current session. So if this is a New York session from 6:30 a.m. to 1 p.m., let's just say we had a TPOC at 29.13. That would be the fair value at the current time. But what I personally like to use is something called a VPOC, or volume point of control, which is basically the highest. It's a price level where it is the highest amount of volume or business transacted. So it will be represented by this pink line right here. Let's see. My notes. One sec. Yeah, you can see, you can say that the profile gives you an edge in the sense that it allows you to record the auction's the market's two-way auction process, and it allows us to see the market structure, and it organizes it very, very nicely. So, for example, if price action gets to higher prices and volume starts to increase at a certain level, that's a clear observation that traders are bidding up the market and buyers are showing initiative at higher prices. But if prices were to go higher, but the volume dies down and then the traders will hit the offer instead because value is not found at the higher prices. And price will reject this high area and it'll go back to lower where there's more willing participants who are willing to buy. So yeah, these are just a few examples of where higher prices could bring new activities and it's just different situations that could occur. But yeah, you could say people's attitudes tend to change in the market when it comes to prices. But regardless of what the market sentiment is, all we should care about is objective data that lets us see and interpret what's going on in the two-way auction process. And I wouldn't consider the market profiles something that gives you buy and sell signals. It's not going to tell you where to buy and sell, but it will give you the market structure, which you could then read the psychology of the market, understand the context, and you can make a play from there. You could say this market structure, it gives us context. So if you're not familiar with the saying context is king, you should get familiar with it because context is one of the most important factors regardless of whatever financial instrument you're trading, because you could have some indicators and have some patterns, but if you don't understand the context, you're not trading with an edge. A lot of people can use indicators and patterns, but the problem is you have everyone using patterns and indicators and they're not really thinking about it. They're not really thinking about the context. Now, I'm not saying you can't use these patterns and indicators with an edge. It's just you gotta think of the market as like a 3D chessboard. You can't think 2D. You gotta think outside the box. You gotta think ahead of what everybody else is thinking, or else like you're with everybody else. You don't have an edge. And I think it's a very important concept to understand. So going on to the next slide. So yeah, this is an example, two different profiles. So this is called a collapsed market profile, and it's expanded market profile. It might look a little confusing, but basically, how do I explain this? Yeah, so both of these charts give insights to different parts of the market structure. We can see the point of control clearly on the collapsed profile. Oh, sorry, the collapsed profile. This is the expanded profile. Sorry, I got that totally mixed up. But yeah, like I was saying, you can see the point of control on the collapsed profile, but you could see real-time technicals on expanded profile because it shows you the price action, and it's basically like 30-minute candles, right? And it shows you how it's reacting to certain price levels, whereas this is just a standard distribution, and it shows you just the distribution of the volume and time. So these two these two different market profile charts actually give you different types of data, which then you could expand upon. Next slide. Let's see. Yeah, so a majority of business is done in something called a value area, which is represented by this green, these green letters. And this value area accounts for 70% of the volume on the day. So anything outside of this value area, these blue areas, they are considered out of value, and they're basically extreme areas on the uh, the range. So you have like a very easy way to see it is like, let's just say you have a regular candlestick chart. You have a bunch of you have price action going up and down, right? But the extremes will basically be the top of the range and the bottom of the range, where there's not enough volume and acceptance to find a directional move, but rather, since the volume is low and there's low acceptance, we're just going to keep going sideways, and most of the volume is conducted in the middle of the range. So yeah, being able to see this data, you would, in a more organized manner, you would, if you can interpret it, if you're able to interpret this data and form a thesis, it will definitely give you a clear edge, because you could understand where everybody is positioned and what type of day we're having, whether it's a trend up day, trend down, or consolidation day. Yeah, you could say this profile chart is like putting pieces of a puzzle together and to form like a thesis. All right, so yeah, so you can see that this TPO chart, it will overlap where the market has been before. So obviously in the middle of the range, there's going to be a lot of TPO stacking, because there's a lot of time spent, right? And each candle represents 30 minutes. So every 30 minutes it spends, it's going to keep stacking here. But as you can see on the outer edges, there's much less time spent, like right here, there's only about like an hour of time spent here. That's why there's only 2 columns. Down here, where 2907, where you see these, oh, sorry. Sorry, I accidentally clicked that. Yeah, so yeah, you see this R session. There's very little time spent here. It's only 30 minutes or less spent at this session. That's why there's a single. But the more time that is spent at a certain price level, you'll see a stacking of TPO. And that's what the market profile just simply tells us, is where time is spent, volume is a volume at each price, and time. Yeah, so how I trade with the market profile, I like to let the profile form a structure at least for 1 hour. So, I mean, without the data, how can you really trade, right? You want to understand how the day is setting up, whether or not we're dealing with a rotational day. So a rotational day will be a sideways day, so it'd just be consolidating in a tight range, or if we have a trend up day. Because if you have a trend up day, the profile would form a different type of distribution. It will be more skewed to one side, right? But this is a very even distribution, relatively even distribution. So this represents a more rotational day, which is just consolidation between the highs and the lows. But now, if we had a trend up day, this value area will be migrating higher. The point of control will be continually moving up, and we will see a bulk of this of the TPL being developed much higher. Let's see. Yeah, so if we're dealing with if you're doing if you're dealing with a rotational day, most likely you have a point of control just staying relatively the same here. It might deviate a few points or so as the day is developed, but as as if it's a rotational day, this point of control would just stay in the middle. Whereas if we had a trend up day or trend down day, this point of control would be continually moving higher and lower, like I said before. So how we would trade a rotational day is since since fair value is here and most of the volume is built here. Anytime it deviates into these low volume areas, these out of value areas, you could basically go short up here, and as long as there's not volume increasing and there's not significant volume increasing and gaining acceptance here by too much time spent, then I would say you could easily go short back to the point of control. And whenever we test the bottom of the range, when it goes out of value and at the bottom of the range, you could go long back to the point of control. And a balanced day, I would say it's relatively easy to trade once you have something like profile chart to reference. Now, let's see. How you would trade a trend up day is in the first hour you will see. I don't have a picture of a trend up day, unfortunately, but how a trend up day would basically form is you'll have like some singles. So like this is an A session, the first 30 minutes, it moves up. Then the B session, it'll continue making new highs each 30-minute session, and that shows that we have a trend up day. And you'll see, like I said, the point of control moving higher, and something like that, you will understand not to fade it if we're having a trend up day, we wouldn't short it too early, because that would be very dangerous. You don't want to be ahead of like a moving train. It's bad. But yeah, I think I'm gonna end the slides. Yeah, so basically that is the basics of the market profile. I will go over more into more advanced strategies with the market profile and the nuances, because there's a lot more to understand about the market profile. But this is I'm just giving you a little basic gist of things, just to play with little auction market theory and just like give you a little intro to this. So this is the end of the presentation. Thank you again for attending this market profile class. Yeah, Mike, you could cut off the recording. Yeah.